Welcome breakers to our weekly market update. And let me ask you one question. Do you also know this feeling of being annoyed and angry with yourself? You knew the move was coming, you prepared, and you were still unprepared. The market simply lulled you in. You lost attention and bam, you were left behind. Let's not be left behind this time. Let's prepare. But how? This is an important video, guys. Let's stay tuned because we want to answer this question and more today. Looking at the weekly chart of the SPY here in front of us and throwing on our monthly levels, indeed it seems as if nothing much has changed. We're still stuck between this monthly liquidity at around 4,180 and our monthly closing level at around 4,080. In other words, this means that the ideas we presented and talked about in last week's analysis are still highly relevant. They still haven't played out. But have a look. Well, the first thing that strikes my eye is this inside bar candle, meaning uncertainty. We don't know which way the price is really going to go. We could push up in the week, then push down, and then the big question mark arises. Is this liquidity still up for grabs, or will we head further down for a bigger pullback? As these ideas could still come to fruition, it may make a lot of sense for you to get a better idea of them. I have linked to the video from last week here, so go check it out. Still, don't be fooled. I expect movement next week. Why? The explanation is simple if you have a closer look at the levels we're actually trapped between. First of all, this monthly liquidity level at 4,180 as well as this level on a closing basis at around 4,135, they are basically resistance areas that mark the current bigger picture downtrend. If you can break them on the weekly, again, you can expect movement up at least to 4,300. Same goes for our level at around 4,080. It marks the monthly swing point that we broke in January and that started our current intermediate monthly uptrend. So it is of high importance and relevance. Imagine a pressure cooker on the stove. In other words, we are trapped between these levels. Yes, but this won't last forever. And once we break out, expect movement. If you don't want to be left behind or trapped on the wrong side of the market in this pressure cooker situation that we have just described, then you have to ask yourself the two most important questions in trading. Number one, where does liquidity lie? And number two, where do we stand in the trend? For that, I have already switched to the daily chart to get a better idea. Throwing on our weekly levels as well as our daily levels, we see that the draw for liquidity upwards obviously still starts at around our well-known 4,180 to 4,220 and to the downside at around 4,035 down to roughly $4,000. We could obviously now also add the liquidity resting underneath this latest daily low at $4,055. Trend-wise, we are in a short-term downtrend. This really has continued throughout the week. However, in an at least intermediate term uptrend on the daily still. The latest daily swing low before we made a new high remains unbroken at around $4,040. So don't be thrown off by these short-term moves in between. Still have your alert ready. I have mine here at around 4,040 and up here at this pool of liquidity. And once it goes off, be ready to jump on board and don't be left behind. This idea still remains highly relevant, and to illustrate that in one other way, let's also look at our weekly target boxes, starting for the bullish one at around 3,968. To the upside, we've tapped it various times, but don't forget we have a weekly fair value gap here as well. If we do the same thing with our daily target boxes, even more confluence down here and another daily bearish target box starting at around 4,229. Where does this new bearish daily target box come from? Let me quickly show you on the charts. Here, having zoomed out, if we take the high from the end of March, pull the fib down to our low, we see that this is exactly where the target box starts at 4,228. One truth in trading certainly also is that emotions don't make for good trades, ever. Correlation, however, does. And for that, let's look at the DXY correlation that we already mentioned several times. SPY, DXY, the dollar index. Here we said we have daily liquidity at 102.64 or up at around 103.88. And what happened? We moved down on the DXY 14th of February. And on the SPY 14th of February, we moved up into our target box. DXY, we then grabbed liquidity, shot up, broke this level, but got rejected on the 17th, 16th of February. And what happened on the SPY? Exactly on these days, we started our move down. So if you want to keep the DXY as a cheat sheet in the back of your minds with respect to what you can expect from the SPY, then it simply comes down to the question, where will we go next on the DXY? So let's zoom in and see what we can find. First of all, I've already had a look before. We have an opening gap here, sitting right above this bit of liquidity, actually, daily liquidity. So let's mark that as well. And then if we throw on our fibs to find out about possible target boxes, we see we have a bearish target box starting at around 105.13. And obviously we could do the same thing for a bullish retracement, because maybe this has already been our short-term or high before we pull back, and this will then give us the target box at around 102. In other words, be aware of what the DXY does. Do we get a retracement here? Then you can expect further up movement in the SPY and vice versa. Finally, and this is a big if, what if we have already spiked the low? In other words, the grab of liquidity to the downside is not going to come anymore, because we already grabbed the liquidity necessary at around 4,060 on Friday. This obviously is a question of the lower time frames, as many of the trades that you can take here in this range at the moment are a question of the lower time frames. If you wonder how to navigate the lower time frames, then watch this video next to find out. Bye bye.